The concept of investing often feels, well, let's be honest, it feels completely daunting.
Oh, absolutely. It's incredibly overwhelming for most people.
Right. Because you can have the most mathematically optimized portfolio in the world, perfectly calibrated for maximum yield.
Yeah, but none of that matters if your psychology isn't aligned with it.
Exactly. If your stomach drops the second the market dips, like 3%, and you panic sell your entire life savings,
At the absolute worst possible moment.
right, then all that math is entirely useless. We see this constantly, don't we?
We really do. People assume investing is purely a numbers game, but the truth is, the primary reason smart people fail at building wealth isn't a lack of financial data,
No, it's because they build portfolios their own psychology simply cannot handle.
which is a profound realization, honestly.
It really is.
We have this tendency to treat the market as, an abstract, logical machine, but we forget that we are the volatile, emotional variables operating within it.
Yeah, we're the wild cards.
Exactly. And if your internal disposition is fundamentally misaligned with your external assets, structural failure is essentially guaranteed.
Well, and that misalignment is exactly what we are tackling in today's deep dive. Our goal today is to cut through all that daunting noise.
I love that.
Yeah. We have a great source today. We are looking at a highly distilled instructional video excerpt, and it's titled Building Your First Investment Portfolio.mp4.
It's a very practical piece of media.
It really is. And the mission of this deep dive is to extract the exact three-step plan provided in this video to help you, our listener, take control of your financial future.
And what's so compelling about this specific source is that it completely skips the typical, jargon-heavy market analysis.
Right, no boring charts.
No, it goes straight for the behavioral mechanic.
Okay, let's unpack this.
Yeah.
Because shifting from being a passive observer of the market to an active architect of your wealth requires a completely different foundational approach than most of us are taught.
Yeah, the source material is quite explicit about this shift. The ultimate goal outlined in the text isn't actually just about accumulating a specific dollar amount.
Wait, really?
Yeah, it explicitly focuses on the idea of taking control and feeling secure.
Oh, wow.
It recognizes that security is, well, it's a psychological state, not just a numerical value on a bank statement.
That makes so much sense. Which brings us to the groundwork, really. The video breaks the process down into three major steps.
Right.
And the first two steps have absolutely nothing to do with capital allocation or asset classes.
Nothing at all. Before you touch a single dollar, the text insists you have to establish your internal baseline.
Exactly.
Yeah.
Step one is to assess your financial goals and understand exactly what you want to achieve.
And then step two is to evaluate your risk tolerance. The source specifically asks the question, are you comfortable with high risks?
Right. And to help visualize this, I like comparing these first two steps to building a house.
Oh, that's a good way to look at it.
Right. Because, you can't pick out the paint colors, which in this case would be your actual investments.
Sure.
You can't pick the paint colors until you've poured a solid foundation. And that foundation is your goals. You have to know what you're building.
I really like that analogy.
Thanks. And then, for step two, you have to check the local weather patterns to see how sturdy the house needs to be.
Right, which represents your risk tolerance.
Exactly. If you're building in a hurricane zone, you need a different structure than if you're building in the mild suburbs.
What's fascinating here is the deliberate separation of those two concepts.
Yeah, tell me more about that.
Well, the source treats defining your goals and evaluating your risk tolerance as two completely distinct mandatory exercises. There is a deep behavioral insight embedded in that separation, because defining a goal like saying, I want aggressive compounding growth to retire early, that's a hollow statement if you don't honestly assess your personal appetite for the volatility required to achieve it.
Oh, I see. Because the goal might require you to endure storms your house just isn't built for.
Exactly. Human beings are incredibly prone to cognitive dissonance when dealing with probability and reward.
We all want the reward, right?
Of course, we all desire the outcome of high returns, but we naturally recoil from the mechanism that generates those returns.
Which is the risk.
Exactly. Which is the risk. So when the source explicitly asks you, are you comfortable with high risks? It forces a confrontation with your own present bias.
Yeah, because in a vacuum, I feel like everyone claims they tolerate risk.
Right. Everyone thinks they're brave until the storm hits. But risk in this context means watching the tangible value of your labor evaporate in real time during a market contraction.
Yeah, seeing those numbers go down on a screen.
Exactly.
I wonder, though, can someone actually evaluate their risk tolerance accurately without having lived through a severe market crash?
That's a really fair question.
Because it feels like asking someone if they are comfortable with freezing temperatures when they've only ever lived in the tropics. They might think they know, but they don't really know until the blizzard actually hits.
Which is precisely why the source places this gut check before any capital is deployed.
Oh, okay.
The text isn't expecting you to perfectly predict your emotional state during a crash,
Right.
but it demands that you acknowledge the reality of the risk before you become, overly enamored with the potential of the reward.
Right, before you get dollar signs in your eyes.
Exactly. If you realize your risk tolerance is low, you have to adjust your goals accordingly. You cannot demand high-yield growth while refusing to accept corresponding volatility.
So the text basically forces you to align your expectations with your actual emotional capacity.
Yes, it's mandatory internal alignment.
Okay, so once we have that internal foundation set, we've poured the concrete for our goals, and we've checked the weather for our risk tolerance, we naturally transition to the external architecture.
Right, the actual assets.
Exactly. Translating that psychology into reality. And this is step 3 from our source, choosing your investment mix.
And the video provides a highly specific allocation model to solve this equation.
It does. It outlines a breakdown of 60% in stocks, 30% in bonds, and 10% in alternatives.
It's a very deliberate structural ratio, and the source clearly delineates the functional purpose of each of those asset classes within the structure.
Right. The text states that stocks are utilized for growth potential.
Yes.
Bonds are included for stability and income.
Exactly.
And then the remaining 10% is allocated to alternatives. The source specifically mentions things like real estate or commodities.
Right.
Now, here's where it gets really interesting.
Yeah.
Because when you look at that 60-30-10 breakdown, it looks like this rigid mathematical formula, right?
So it's very clinical, yeah.
But to help you visualize this, I like to use a cooking analogy.
Oh, let's hear it.
So imagine you're cooking a complex dish. The stocks, that 60%, those are your spicy main ingredient.
Okay, I'm with you.
They drive the flavor of the dish. That's your growth potential. But if you just eat a bowl of pure spice, it's going to ruin your stomach, right?
Yeah, that would be a very painful meal.
Exactly. So you need a starchy base, like rice or potatoes, to keep the dish grounded and digestible.
And that's the 30% in bonds.
Exactly. The bonds provide that stability. They don't have the exciting flavor, but they make the meal sustainable.
I love that.
And then that last 10% in alternatives, like real estate or commodities, that's your exotic seasoning.
Ah.
It adds a completely unique kick that operates on a different flavor profile entirely.
If we connect this to the bigger picture, this specific 6 euro, 3 euro, 10 breakdown directly answers the needs we outlined in step 1 and 2.
Right.
It provides a mathematical solution to the very human desire for both growth and safety.
Because it balances the spice with the starch.
Exactly. And the introduction of that 10% in alternatives is a really sophisticated way of altering the efficient frontier of the portfolio. Well, the source specifically mentions real estate or commodities because they represent non-correlated assets.
Meaning they don't move with the stock market.
Right. They do not behave like traditional corporate equities or government debt.
Okay.
So when inflation spikes, traditional stocks and bonds often suffer simultaneously. But hard assets like your exotic seasoning.
Real estate or commodities.
Exactly. Those often appreciate during inflationary periods. By dedicating a tenth of the portfolio to assets operating outside the standard financial ecosystem, the text adds a secondary layer of structural integrity.
Oh, wow.
Yeah, it protects against systemic shocks.
It really operates as a masterclass in behavioral design.
It really does.
Like the 60-30-10 mix isn't just about maximizing compound interest. It's practically about minimizing investor panic.
Exactly. It designs the portfolio around the flaws of human nature, rather than expecting human nature to perfectly adapt to the cold mathematics of the market.
Right. It gives you enough growth to satisfy your ambition, enough stability to let you sleep at night, and enough alternative exposure to protect you when the primary systems fail.
It's a system designed to survive the investor's own worst impulses.
But building that perfect portfolio is really only the first part of the journey, isn't it?
Yeah, the setup is just the beginning.
Because once you've built it, we have to address how to protect it from falling apart over time. We have to transition from building the machine to maintaining it.
And this is where we get into the safety net.
Right. The video states very clearly that diversification is key because it spreads risk across different formats.
And it illustrates this concept with a vital mechanical truth. It points out the balancing act where if stocks fall, bonds may rise.
Yeah, it sets up this dynamic of opposing forces protecting the core.
Exactly.
But then the source adds two specific ongoing directives for the investor.
What are they?
First, to start small and grow over time.
Okay.
And second, to revisit your portfolio regularly for adjustments. Right. So what does this all mean? Because I have to admit, I see a massive contradiction here.
Really? Let's pull that apart. Where
Yeah.
do you see the contradiction?
Well, if this 60310 architecture is so perfectly calibrated to handle both growth and stability, why on earth do we need to constantly tinker with it?
No.
The directive to revisit your portfolio regularly for adjustments feels almost counterproductive. Like, shouldn't a perfectly engineered machine just run autonomously?
I see what you mean.
And furthermore, if our ultimate goal is to secure our financial future, which obviously requires a substantial amount of capital, isn't the advice to start small, actively working against the math of compound growth?
Those are fundamental friction points, absolutely.
It feels like we are being told to build this perfect dish and then constantly mess with the recipe while we're eating it.
Well, they strike right at the heart of how market mechanics operate in reality versus in theory. Let's address the maintenance directive first.
Okay, let's do it.
The phrase the source uses, balancing act, is crucial here. It notes that if stocks fall, bonds may rise. This highlights that these different asset classes are moving at completely different velocities. The spicy main dish and the starchy base are cooking at different speeds.
Right, because they react to the same economic environment in opposite ways.
Yes. So let's say you deploy your capital perfectly into that 60-30-10 alignment. You've achieved structural harmony.
Perfect balance.
But over the next 2 years, we experience a massive bull market.
Okay.
The equities in your portfolio surge in value while your bonds continue to deliver their slow, steady, methodical yield.
Oh, I see where this is going.
Mathematically, because the stocks grew so aggressively, they now represent, say, 75% of your total portfolio's value, while your bonds have shrunk to 15%.
Oh, wow. So the success of the growth actually causes the whole mix to get completely out of whack.
Exactly. Your portfolio has experienced what we call drift. By doing absolutely nothing, your risk profile has drastically changed.
Because now you have way too much spice and not enough starch to handle it.
Precisely. You are now holding a portfolio with oversized volatility and heavily decreased stability.
That's terrifying, actually.
It is, because if the market suddenly turns, you will experience a much more violent drop than you initially planned for. Your stabilizing allocation has been mathematically diluted by your own success.
Oh. So the directive to revisit your portfolio regularly for adjustments isn't about second-guessing the market at all.
Not at all.
It's about forcing the portfolio back to its original engineered state.
It's the mechanical process of rebalancing. And this is where the psychology gets incredibly difficult.
Why is it difficult?
Because to get back to the 60-30-10 ratio, you have to sell off the asset that has been performing brilliantly, your stocks.
Right.
And you use that capital to buy more of the asset that has been doing very little, your bonds.
Oh, yeah. That is deeply counterintuitive.
Exactly.
Human instinct screams at us to let the winners run and ditch the losers.
Right. Which is exactly why most investors fail. They let their emotions dictate their allocation. The text's rule of mechanical adjustment forces you to systematically lock in your gains and continuously restore your safety net.
So it creates an emotionless mechanism that forces you to buy low and sell high.
Yes, it removes human sentiment from the equation entirely.
That completely reframes the concept of maintenance for me. The machine doesn't stay perfect precisely because it is interacting with a dynamic environment.
Exactly.
The adjustment is what maintains the perfection.
Exactly that.
Okay, now what about the other piece of friction?
The start small directive.
Yeah, the directive to start small and grow over time. If I have a massive financial goal, why am I handicapping my initial compound interest by starting small?
Well, you have to look at that directive through the lens of the psychological groundwork we established in steps 1 and 2.
The goals and the risk tolerance.
Right. The barrier to entry for securing your financial future isn't a lack of capital. It's the paralysis induced by fear.
Oh, absolutely. The financial jungle is so noisy.
And the consequences of a mistake feel catastrophic.
Right.
So the instruction to start small is a deliberate behavioral intervention. It artificially lowers the stakes of the initial deployment.
So it's not actually about the money at all in the beginning.
No.
It's about like exposure therapy.
That's a great way to put it. It gets you off the sidelines without triggering an overwhelming panic response.
Right.
Over time, as you observe the mechanics actually functioning, as you watch your bonds provide stability while your stocks fluctuate, your confidence solidifies.
Yeah.
You learn to trust the architecture.
Because you're seeing it work in real life.
Exactly. Your risk tolerance matures because you are no longer dealing with theoretical volatility. You are experiencing managed, mitigated volatility.
You start small, so the habit of active architecture can actually take root.
Yes. The phrase grow over time applies just as much to your behavioral competence as it does to your financial capital.
Building the competence to actually manage the wealth you are trying to accumulate.
Right.
That makes perfect sense. It relieves the pressure of needing to understand the entirety of global economics before making a single move.
Exactly. You don't need a PhD in finance.
You just lay the foundation, build the basic 603010 structure, and let the process teach you the rest.
It bridges the gap between our emotional vulnerabilities and the stark mathematical realities of long-term financial security.
So let's distill this entire deep dive back down into the absolute core takeaways for you, the listener.
Sounds good.
The source provides a definitive 3-step blueprint to cut through the noise. 1. Define your goals clearly.
Right. You have to know the specific foundation you are trying to pour.
Exactly. 2. Critically evaluate your risk tolerance. You must know what kind of weather your structure can withstand before you start building.
Before you become distracted by the potential rewards.
Yes. And 3. Mix your investments wisely. Utilize that 603-10 architecture, allocating for growth potential, stability and income, and alternative assets.
Right.
That engineered mix protects you from both the market swings and your own emotional instincts.
And crucially, commit to the mechanical maintenance of that system. Embrace the balancing act.
Yes, revisit that portfolio.
Allow the different asset classes to do their specific jobs, but ensure you revisit the portfolio regularly to force those forces back into their optimal protective proportions.
Rebalance the recipe so it doesn't get too spicy.
Exactly.
The final rallying cry from the video excerpt really summarizes the urgency of this entire shift in mindset. It says, start now. Take control and secure your financial future.
It's a powerful call to action.
It is. You don't need to master the complex jargon or decipher the flashing numbers on a screen. The actual blueprint is clear, it's structured, and it's fundamentally rooted in your own self-awareness.
It represents a shift from a reactive state of anxiety to a proactive state of design. You build the structure to weather the environment, rather than constantly trying to predict the weather.
Which brings up a final thought I want to leave you with today.
Okay.
The most profound concept in this source material isn't a specific percentage or an asset class.
No, it's not.
It's actually the underlying philosophy of the balancing act itself.
Yeah.
The text explicitly notes that if stocks fall, bonds may rise. It demonstrates that ultimate stability isn't achieved by finding one perfect, flawless thing.
Right, because that doesn't exist.
Exactly. True stability is engineered by intentionally combining opposing, seemingly contradictory forces.
Yeah.
You need the aggressive push of growth and the resistant pull of stability to keep the entire system centered.
It's a beautiful way to look at it.
So as you move away from the financial metrics and back into your daily routine, I want you to ponder this. What other areas of your life, whether it's your career trajectory, the dynamics of your personal relationships, or even the structure of your daily habits, could fundamentally benefit from intentionally pairing opposing forces to protect your long-term goals?
That is a powerful concept. Realizing that introducing a contradictory element might be the very thing that secures your foundation.
A perfectly engineered balance. Well, until next time, keep building.